They took 8% from the market in a single day. Panic spread like wildfire. Headlines screamed that the bull run was finished. But within 24 hours, something extraordinary happened. The price surged back. $3.35 recovered. This was not a correction. This was not natural market behavior. Someone knew exactly what they were doing. Someone profited while others lost everything. The question is not what happened. The question is, who orchestrated it? Welcome to Financial Revelations. This is where the patterns behind market chaos become clear. Now, if you have been following financial markets for decades, if you remember when information was harder to come by and wisdom was earned through experience, then you understand the value of what we do here. We ask you, as one would ask a trusted colleague, to subscribe to this channel, not for entertainment, but because what unfolds in these analyses could protect your portfolio, your legacy, your financial future. And we are curious, where are you watching this from today? Are you in North America, Europe, Asia? Perhaps somewhere the banks do not expect you to be paying attention. Leave a comment below. Let us know your location, because this story, this trap, it affected investors everywhere. Now, let us dissect exactly what happened in these critical 24 hours. December 29th, 2025 began like any other trading day. But what unfolded over the next 24 hours would expose one of the most calculated traps in recent silver market history. At precisely 9:30 a.m. Eastern Time, silver was trading at $79.89 per ounce. The metal had been climbing steadily for months. Investors were confident. Analysts were bullish. Everything seemed stable. Then, without warning, the floor collapsed. Within 6 hours, silver had plummeted to $71, an 8% decline in a single trading session. The financial media erupted with panic. Headlines declared the bull market dead. Analysts who were bullish just hours earlier suddenly reversed their positions. Social media platforms flooded with fear. Retail investors watched their portfolios bleed. But here is what most people missed. Here's what separated those who understood from those who panicked. This was not a natural market movement. The data reveals something far more deliberate, something institutional, something orchestrated. When analysts examined the trading volume during the collapse, they noticed an anomaly. The sell orders were not coming from panicked retail investors alone. Large block orders appeared at specific price points, orders too large, too coordinated to be coincidental. Someone was pushing the market down intentionally. Someone with enough capital to move prices. Someone who knew exactly where the breaking points were. The critical threshold was $72. This price level held significance. It was where thousands of retail investors had placed their stop-loss orders. A stop-loss order is a safety mechanism. When the price falls to a certain level, the position automatically sells. It protects investors from catastrophic losses, or so they believe. But in this case, the stop-loss orders became the weapon used against them. As silver broke through $72, a cascade began. One stop-loss triggered another, then thousands more. The selling pressure became self-reinforcing. Each triggered stop-loss added more downward momentum. The market entered what traders call a death spiral, and someone was waiting at the bottom. By the time silver hit $71, the weak hands had been completely flushed out. Retail investors had sold at the worst possible moment. Their positions were gone. Their capital was transferred. But to whom? That night, as markets closed, the narrative was clear. Silver was finished. The bull run was over. Investors who held on were called foolish. Those who sold congratulated themselves for cutting losses. Then December 30th arrived. At market open, something unexpected happened. Silver did not continue falling. Instead, it began to climb. Not slowly, not gradually, but aggressively. Within hours, silver had recovered $3.35. The price surged to $74.54, a 5% gain in a single session. The same analysts who declared the bull market dead were now scrambling to explain the reversal. The same media outlets that spread panic were now reporting a surprising recovery. But for those who understood market mechanics, there was no surprise. This was the trap springing shut. The violent price collapse had served its purpose. It had separated conviction from speculation. It had transferred positions from weak hands to strong hands. It had created the liquidity that institutional buyers desperately needed. And now, with retail investors sitting on the sidelines, having sold at the bottom, the real buying could begin. This V-shaped recovery, this dramatic reversal within 24 hours, revealed the truth that many refused to see. The crash was not a market correction. It was not a response to fundamentals. It was not driven by economic data. It was a bear trap, a calculated mechanism designed to extract value from those who did not understand the game being played. The question now becomes critical. Who orchestrated this? What mechanics were employed? And most importantly, how can investors recognize when they are being positioned as prey rather than participants? The anatomy of this trap runs deeper than most realize, and understanding it could mean the difference between building wealth and becoming the source of someone else's. There is a game being played in financial markets that most participants do not even know exists, a game where the rules are written by those with the most capital, where the playing field is deliberately tilted, and where information itself becomes a weapon. What happened to silver on December 29th was not chaos, it was architecture. To understand how this trap functioned, one must first understand a fundamental truth about modern markets. Liquidity does not appear naturally when institutional money needs it. It must be created. And creation, in this context, means extraction. Consider the position of a large pension fund in late December. They manage billions of dollars. Their investment committee has decided to allocate capital into precious metals. The decision was made weeks ago, but there is a problem. At $79 per ounce, there are not enough sellers. The strong hands, those who accumulated silver at $40, $50, $60, they are not selling. They understand where this market is headed. They have conviction. So the pension fund faces a dilemma. How does one buy millions of ounces when nobody is selling? The answer lies in manufacturing fear. This is where algorithmic trading systems enter the picture. These are not human traders making emotional decisions. These are mathematical programs designed to identify vulnerabilities in market structure. The algorithms scan the order books. They identify where retail investors have clustered their stop-loss orders. They calculate the exact price level that will trigger a cascade. $72, that was the number. The data showed massive stop-loss concentration at this threshold. Retail investors, believing they were protecting themselves, had inadvertently created a loaded spring. All it needed was pressure. On the morning of December 29th, large sell orders began appearing. Not all at once. That would be too obvious. Instead, they came in waves, strategic waves designed to create momentum. The first wave pushed silver from $79 to $76. This created uncertainty. The second wave drove it to $74. Now concern began spreading. The third wave broke through $73. Now fear took hold. And then, the critical moment, silver touched $72. What followed was automatic. Thousands of stop-loss orders activated simultaneously. Retail positions converted to sell orders instantly. The selling pressure became exponential. This is what traders call a cascade event, but that term sanitizes what actually occurs. What really happens is a transfer of wealth from those who trade on fear to those who create the fear. As silver plunged from $72 to $71, institutional buy orders were waiting, not visible to retail traders, not appearing on standard market feeds, but executing nonetheless. These orders absorbed the panic selling. Every share that a retail investor dumped at $71 was purchased by someone who knew exactly what was happening. The pension funds got their allocation. The hedge funds covered their short positions. The commercial traders accumulated their desired exposure. All at prices that would have been impossible to achieve without the manufactured panic. But the mechanics went even deeper than simple stop-loss targeting. The futures market played a critical role. Futures contracts allow traders to control large amounts of silver with relatively small capital. This creates leverage, and leverage creates vulnerability. Many retail investors were not holding physical silver. They were holding leveraged futures positions. When prices began falling, their brokers issued margin calls. These are demands for additional capital to maintain positions. Investors faced a choice: deposit more money immediately, or have positions liquidated automatically. Most did not have additional capital available. Their positions were closed by force. More selling pressure, more downward momentum, more opportunity for institutional accumulation. And throughout this entire process, the financial media amplified the panic. Headlines screamed about the silver crash. Analysts appeared on television declaring the bull market finished. Social media influencers posted videos telling followers to cut losses and run. This was not coincidental reporting. This was narrative coordination. Because for the trap to work completely, psychology must be weaponized alongside mechanics. Fear must be made contagious. Doubt must spread faster than analysis. By the time December 29th closed, the trap had executed perfectly. Weak hands eliminated, strong hands rewarded for patience, institutional positions filled. And then, just as designed, the reversal began. December 30th opened with aggressive buying, not from retail investors. They had already been flushed out, but from the same institutional players who had manufactured the decline. They were not buying back what they sold. They were buying what others had panic sold to them, and they were buying more. The price surged from $71 back towards $74, a 5% gain that recovered nearly half of the previous day's losses. Well, for those who understood, this confirmed everything. The crash was never about fundamentals. It was about liquidity extraction. It was about position transfer. It was about taking from those who react and giving to those who plan. This pattern has occurred before. It will occur again, because as long as markets operate with information asymmetry, as long as retail investors remain predictable, as long as fear can be manufactured on demand, the trap will always be set, and it will always find victims. History does not repeat itself, but it rhymes with disturbing precision. What occurred on December 29th was not an isolated incident. It was not an anomaly. It was not even particularly creative. It was a playbook that has been executed before, a playbook that will be executed again. And the most troubling aspect is not that it happens, but that investors continue to fall for it every single time. Rewind to March 2020. The world was gripping with pandemic uncertainty. Markets were collapsing across every asset class. And silver was caught in a historic vice. In a single week, the metal plunged from $18 to $12, a 33% collapse. Investors watched in horror as their positions evaporated. The financial media declared precious metals dead. Analysts proclaimed that the safe haven narrative was finished. Then something remarkable happened. Within 3 months, silver had doubled. By August 2020, it touched $30. Those who sold at $12 watched from the sidelines. Those who understood the pattern accumulated at the bottom. The mechanism was identical to December 2025. Manufactured panic, stop-loss cascades, institutional accumulation disguised as market chaos. Fast forward to May 2023, silver was trading at $26. The banking crisis had just erupted. Regional banks were collapsing. Fear was spreading through the financial system. Logic suggested that precious metals would surge as safe havens. Instead, silver crashed to $20 in 72 hours. The panic was immediate. Retail investors fled. Experts declared the silver bull market permanently broken. But within 6 weeks, the price had recovered entirely. And within 4 months, silver was trading above its pre-crash levels. Again, the same playbook. Again, the same victims. Again, the same beneficiaries. So why does this pattern persist? Why do intelligent investors continue falling into the same trap? The answer lies in human psychology and the systematic exploitation of predictable behavior. Humans are wired to respond to immediate threats. When portfolio values collapse rapidly, the primitive brain activates. Fear overrides analysis. Survival instinct overrides strategy. This is not weakness. This is biology. But institutional traders understand this biology. They have studied it, they have quantified it, they have built algorithms specifically designed to trigger it. Every bear trap follows the same psychological progression. Stage 1, comfort. Prices are stable or rising. Investors feel confident in their positions. Stop losses are set at safe levels. Stage 2, concern. Price begins declining without clear fundamental reason. Media coverage shifts from bullish to cautious. Investors tell themselves, this is just a pullback. Stage 3, fear. The decline accelerates. Stop losses begin triggering. Headlines turn definitively negative. Investors question their original thesis. Stage 4, panic. Cascading selling creates a vertical price collapse. Every tick down confirms the fear. The only thought becomes, get out before it goes to zero. Stage 5, capitulation. Positions are sold at the absolute worst prices. Investors feel relief that the bleeding has stopped. The trap is closed completely. Then comes stage 6, recovery. Prices surge back rapidly. Those who sold watch in disbelief. The realization hits that they were played. This 6-stage cycle has repeated across decades of market history. Not just in silver, not just in commodities, but in every asset class where retail participation meets institutional manipulation. The 1987 stock market crash followed this pattern. The 2008 financial crisis executed it on a massive scale. The 2020 COVID crash was a textbook example. The cryptocurrency flash crashes of 2021 and 2022 replicated it perfectly. And now, December the 2025, silver. Same pattern, same mechanics, same outcome. But there is another layer to understand, a layer that reveals why these events cluster around specific calendar dates. December is not random. Year-end is not coincidental. Institutional fund managers operate under quarterly and annual reporting requirements. Their performance is measured on December 31st. Their bonuses depend on how portfolios appear on that specific date. This creates what market analysts call window dressing, the practice of adjusting positions before reporting deadlines to create favorable appearances. A fund manager who missed silver's rise all year suddenly needs exposure before year end. But buying at $80 looks like chasing. It looks like poor timing. It raises questions from investors. However, if that same manager can engineer a crash, accumulate at $71, and show the position on December 31st reporting, now it looks strategic. Now it looks like brilliant timing. Now it justifies next year's management fees. This is why bear traps concentrate around quarter ends. This is why volatility spikes before major reporting deadlines. This is why patterns repeat with calendar precision. The market structure itself creates the incentive for manipulation. The regulatory framework fails to prevent it. The information asymmetry enables it. And retail investors, checking their portfolios once or twice daily, reading mainstream financial news, setting predictable stop losses, they provide the liquidity that makes the entire scheme possible. The data is unmistakable. Analysts who track institutional positioning through CFTC reports observed something telling in the weeks before December 29th. Commercial traders, the category that includes banks and large institutional players, were steadily reducing short positions. Meanwhile, retail sentiment reached extreme bullish levels. Everyone expected silver to finish the year at $85 or $90. This divergence, institutional caution against retail exuberance, is always the warning sign. It appears before every major bear trap. It signals that the setup is complete. It means the prey is positioned exactly where the predator needs them. What makes December 2025 particularly instructive is how quickly the pattern completed. 24 hours from trap to recovery. This speed reveals confidence. The orchestrators knew exactly how this would unfold. They had run this play before. They knew the outcome before the first sell order executed. And they know it will work again, because the fundamental dynamic never changes. As long as retail investors remain predictable, as long as fear can be manufactured on demand, as long as information flows asymmetrically, the pattern will continue. The traps will be set. And history will keep rhyming. The trap is closed. The victims have been identified. The beneficiaries have collected their spoils. But the most critical question remains unanswered. What does an intelligent investor do with this information? Because understanding what happened is merely academic, unless that understanding translates into actionable strategy, unless it changes behavior, unless it prevents the next trap from claiming another victim. December 30th ended with silver trading at $74.54, a remarkable recovery, but still below the $79 where this began. This creates a specific market condition, one that reveals where the true players are positioning for what comes next. The weak hands are gone. They sold at $71. They are now sitting in cash, watching the recovery, paralyzed by regret, afraid to re-enter because what if it crashes again? The strong hands never left. They held through the volatility. Some even accumulated more during the panic. They understood this was theater, not transformation. And the institutional players, they now hold the positions they needed, at prices they could not have achieved without manufacturing the crisis. So what happens in the final trading hours of 2025? What happens as the calendar turns to 2026? History provides guidance. After bear traps execute successfully, markets typically enter consolidation phases. The dramatic volatility subsides. Price action becomes range-bound. Uncertainty replaces panic. This consolidation serves multiple purposes. It allows institutional positions to be fully established without moving prices higher prematurely. It creates doubt in retail investors who might consider re-entering. It provides time for the narrative to shift from crash to recovery to new normal. For silver specifically, the $72 to $76 range becomes the new battlefield. This is where the remaining uncertainty gets resolved. This is where the next directional move gets established. But here is what most investors miss. Here's the lesson that separates strategic thinking from reactive trading. The 24-hour crash and recovery was not about December prices. It was about January positioning. The institutions that accumulated at $71 are not planning to sell at $75. That would make no sense. The entire operation would be pointless for a 5% gain. They are positioning for what they see coming in 2026. They are positioning for movements measured in multiples, not percentages. This is where fundamental analysis becomes essential, because while price action was manufactured, the underlying forces driving silver remain unchanged. Global monetary debasement continues. Central banks are still expanding money supplies. Government debt continues reaching historic levels. Currency devaluation remains the unspoken policy of every major economy. These are not temporary conditions. These are structural realities of the modern financial system. Silver, as both an industrial metal and a monetary asset, sits at the intersection of multiple megatrends. The green energy transition requires massive silver consumption. Solar panel production depends on it. Electric vehicle manufacturing needs it. Simultaneously, as fiat currencies lose purchasing power, precious metals become increasingly attractive stores of value. None of these fundamentals changed during the December 29th crash. The supply and demand dynamics remain identical. The monetary environment is unchanged. The industrial requirements continue growing. What changed was only price. And price, in the short term, is determined by liquidity mechanics and psychological manipulation, not by fundamentals. This creates the strategic framework for intelligent positioning. First principle: separate price from value. Price is what you pay. Value is what you receive. They are related, but not identical. When price temporarily disconnects from value due to manufactured panic, opportunities emerge, but only for those who can distinguish between the two. Only for those who are not slaves to short-term volatility. Second principle: understand your position size relative to your conviction. If an 8% decline in 24 hours causes panic, if it forces selling to stop the bleeding, then the position was too large relative to conviction. True strategic positions are sized so that volatility becomes opportunity rather than crisis, so that crashes prompt accumulation rather than liquidation. This requires honest self-assessment. Most investors overestimate their risk tolerance in calm markets, then discover their true limits when volatility strikes. Third principle: recognize that leverage is the enemy of conviction. The investors who were forced to sell during the December 29th crash were primarily those using leverage, those holding futures, contracts with margin requirements, those who borrowed to increase position size. Leverage converts volatility into existential threat. It removes the ability to wait for recovery. It transforms paper losses into realized losses. Physical silver holders did not panic on December 29th because they could not receive margin calls, because their positions could not be forcibly liquidated, because they owned the actual asset, not a derivative contract. Fourth principle: understand the game being played. Markets are not neutral arbiters of value. They are battlegrounds where information asymmetry creates advantage, where capital size creates power, where psychology can be weaponized. Retail investors who approach markets believing in fair price discovery are bringing knives to gunfights. The game is not fair. The game has never been fair. The game is designed to transfer wealth from the uninformed to the informed, from the reactive to the strategic, from the emotional to the analytical. But understanding the game changes everything. when you recognize a bear trap while it is happening, when you can see through manufactured panic to underlying mechanics, when you can separate signal from noise, you stop being the target. You become the beneficiary. Fifth principle, prepare for recurrence. What happened on December 29th will happen again, perhaps not in silver, perhaps not in 2026, but the pattern will repeat. Because the structural conditions that enable these traps persist, because regulatory frameworks remain inadequate, because human psychology remains exploitable, the sophisticated investor builds systems that anticipate volatility rather than react to it, position sizing that allows weathering storms, cash reserves that enable buying crashes rather than selling them, analytical frameworks that distinguish manipulation from legitimate price discovery. As 2025 closes and 2026 begins, silver sits at a crossroads. The technical damage from December 29th will take time to repair. The psychological scars on retail investors will take longer. But the fundamental drivers remain intact. The institutional accumulation is complete. The weak hands have been eliminated. What comes next is not a continuation of volatility, but a resolution of the real question. Where does silver go when the manipulators stop suppressing and start promoting? What happens when the same institutional power that crashed the price decides to drive it higher? Because that is the final phase of the playbook. Accumulate at suppressed prices, then promote at inflated prices. Sell to the next wave of retail investors who chase performance. The cycle is eternal. The pattern is predictable. The outcome is predetermined. Unless you understand it, unless you position strategically rather than emotionally, unless you recognize which side of the trade you are on. December 29th, 2025 was not a market event. It was a transfer event. Wealth moved from those who panicked to those who planned, from those who reacted to those who understood. The trap was set. The trap was sprung. The trap worked exactly as designed. The only question that matters now is simple. When the next trap is set, will you be the architect or the victim?